In this video, we're going to start talking about bonds payable. So what exactly is a bond? Well, a bond is a form of debt. So it's not exactly like going to the bank and borrowing money, but it still involves borrowing money. A bond can be issued by the government, and it can also be issued by corporations. So you get different kinds of bonds. So basically how a bond works. So we have a company that needs money for whatever reason. So if a company decides they need a large influx of cash, a bond is usually a good way to go because sometimes companies want a lot of money, which banks aren't willing to lend them in such large amounts, and a bond is a good way to go about that. So if a company decides it needs money, which would be a corporate bond that we're talking about, it will then reach out to the public. And the public is the source of that funding. So what happens is by selling bonds to the public, the company gets money. So that they are essentially borrowing money from the public. And usually bonds are sold in 1,000 pieces at a time, so to speak. That's often the face value. So a company can, for example, borrow $50 million, but it's in 1,000 different pieces. So, for example, one individual can buy just $1,000, a portion of that bond at $1,000 face value, but that one person makes up a whole bunch of other people that are now financing a portion of this business, whatever this business needs the money for. So the company borrows the money, and the company promises to pay that money back in a certain number of years or months, but oftentimes it's several years, 20 years, 30 years, 15 years, 10 years, whatever it is. So the company borrows money, and then at the end of the bond's life, when the bond matures, the company will then pay all of that money back. But it kind of would seem to suck. So assume it's a 10-year bond. Would kind of suck if you have to sit around for 10 years to wait for that money to be paid back. And plus, what's in it for me, right, if I'm buying a bond from a company? Well, in exchange for borrowing that money from the public, the company then agrees to periodically pay interest. This could be once a year, twice a year, which is semi-annual. A common term is for semi-annual interest payments to occur. So in between the time that the bond is issued and the time the bond is paid back, the company will pay periodic interest payments to those bond holders. So every couple or so months, however often interest is paid, every 6 months is the most often, every 6 months or so if it's semi-annual, all the bond holders will get interest paid to them. And that interest is calculated by taking the face value of the bond times the stated interest rate on the bond. And then after the bond matures, if it's a 10-year bond, after the 10 years are up, not only will the bond issuer, the company, pay that last interest payment in year 10, but then at the end of the year 10, all the face value of the bond will be paid back in full to the bond holders. So the nice thing about this for the bond holders is they get a return that happens at a definite time throughout those 10 years or the 15 years or the 30 years. They have to wait a while for the overall money to be paid back, but it's seen as a constant stream of income that is predictable if you're a bond holder. And the nice thing for the company is this allows them to borrow a lot of money at a time that they might not be able to borrow from a bank. So depending on the corporation, a bond might be risky or it might be safe. So depending on the company's creditworthiness, the public, the people buying the bonds, will either be willing to pay a little bit more for a bond or a little bit less for the bond, depending on current market interest rates and depending on how safe the investment is. If the company's creditworthiness is rated as low, they are going to either they're going to be wanting to pay a little bit less for the bond, and they're going to demand a higher interest rate to be paid to them in exchange for that risk. However, if the company has very high credit rating, then the bondholders would be willing to accept possibly a little bit smaller interest rate and would be willing to pay even a little bit more for that bond. So it just depends on the credit worthiness. And when it comes to government bonds, those are really safe investments. So the government's credit worthiness is rated high. So that's the general example of how a bond works. Now that we've briefly talked about how a bond works, we're just going to quickly look at the tax advantages of debt. So we'll specifically look at a bond. So let's assume that a corporation pays income taxes at a rate of 30% on its taxable income. If this corporation issues $10 million of 6% bonds payable, it will incur interest expense of $600,000 per year. And how do they get that $600,000? Well, they took the $10 million, multiplied it by the interest rate of 6%. So that's $600,000 of interest being paid to bondholders. Now, what do we know about interest expense? Well, interest expense, along with all our other expenses, reduces taxable income. So the more interest expense we have to pay, the lower our taxable income, and the lower our taxable income, the lower our taxes. So how much will the $600,000 reduce our taxable income? Well, if the interest expense is $600,000, it will reduce our taxable income by $600,000. Now, what's the tax implication of that? Well, the interest expense, again, interest expense goes up by $600,000. Taxable income would go down by $600,000. Well, remember, what tax rate are they operating in? They're paying an overall average tax rate of 30% here. That's the rate of their taxes. So remember, on their taxable income, they have to pay 30% in taxes. Well, if this interest expense reduces their taxable income by $600,000, we can find out what the tax impact of that will be. So if we take the $600,000 and we multiply it by 30%, let's see what that comes out to. That comes out to $180,000. So by having the $600,000 in interest expense, that reduces the company's annual income taxes by $180,000. So that's a reduction in taxes for this company because now they have a lower income, which is lower taxes as a result of this large interest expense here. So really, let's look at the after-tax cost of this interest expense. If we take away the amount of taxes that we're saving with this increased expense, let's see what the after-tax cost is of this interest expense. So that's $420,000. This is the after-tax cost of borrowing that $10 million in the form of bonds. So the after-tax cost of borrowing that money is only $420,000. Although we're paying $600,000 in interest expense, that reduces our taxable income, which reduces our taxes. So really, at the end of the day, by the taxes we're saving, the after-tax cost of that interest is only $420,000. So really, what's the effective rate of interest here? What's the interest rate we're technically really borrowing? So instead of taking the $600,000 out of the $10 million, we know that is 6%. But we said really the after-tax cost of borrowing that money is really $420,000 on those $10 million of bonds. So when we take $420,000 divided by 10 million, that's 4.2%. So although we're paying 6% interest, the after-tax cost of interest is actually $420,000. So the effective interest rate that we're actually paying on these bonds, on this money we borrowed, is 4.2%. So that's the effective interest rate. So the effective interest rate takes into account any tax implications, in this case, tax savings. So that's just a quick overview on the tax advantages of debt financing.